In Omaha, Nebraska, a man known as the Oracle has spent his life building one of the world's greatest fortunes. His secret isn't magic, it's a simple time-tested philosophy: buy wonderful companies at a fair price and hold them forever. But here is a question no one is asking. What if Warren Buffett, the man who built his empire on American giants like Coca-Cola and Apple, looked beyond his home country and set his sights on one of Africa's largest economy? What if he saw the hidden opportunities in Nigeria? The big question is, if Warren Buffett invested in Nigeria, what would his portfolio look like? What Nigerian stocks would meet his legendary criteria? Hello, my colleagues, welcome back to the channel, and if you are new here, you are absolutely welcome as well. In today's video, we are going to be doing a deep dive into the mind of the world's most famous value investor. We'll be applying his rigorous investment principles to the Nigerian stock market to find the hidden gems with strong management, durable competitive advantages, and the potential for long-term growth. In this video, we will cover Buffett's core investment checklist and how it applies to Nigeria, the top Nigerian stocks that fit his buy and hold forever philosophy, and why patience and a long-term mindset are the ultimate weapon for every investor in this market. So make sure you stick around to the very end of this video, and before we jump in, please do me a quick favor: smash that like button, guys, so this video can reach more Nigerians who need to see a smarter way to thinking about investing. Don't forget to subscribe if you are here to subscribe to the channel, and turn on the notification bell so you never miss an update anytime I drop a new video. I also left a link in the description and pinned comments to join my WhatsApp channel, where I share my latest market research and insights in real time. And if you'd like to book a one-on-one call with me, the links are also in the description. All right, without much talk, let's jump right into today's video. Let's go. When people think of Warren Buffett, they picture the billions, the headlines, and the annual shareholders meeting in Omaha that feels like a festival. But beneath all that, his philosophy is surprisingly simple, and that's why it works, guys. For Buffett, the stock market isn't a casino, it's a marketplace of businesses. He doesn't see stock tickers, he sees companies with real products, managers, customers, and profits. His guiding question is always, if I buy this company, would I comfortably own it for the next 20 years? And that's where his famous idea of a moat comes in. A moat is what protects a castle, and for businesses, it's the advantages that keeps competitors from easily taking their place in the marketplace. It could be brand power, cost advantages, or even control over critical resources. Buffett looks for companies with moats so wide and deep that they can defend profit year after year. Cash flow is another pillar. He prefers companies that produce steady, reliable earnings, often rewarding shareholders with dividends. For him, predictability is more valuable than hype. And perhaps most importantly, Buffett avoids speculation. He doesn't chase quick flips or market noise. His entire empire rests on patience, buying companies with real value and holding them long enough for that value to compound. So here's the big question: what happens when we take these timeless filters and drop them right here into the Nigerian market? Let's jump right in. Now that we have the checklist, let's start filtering. Buffett's most fundamental rule is this: never invest in a business you cannot understand. You see, during the dot-com bubble, he famously avoided early tech companies because they were outside his circle of competence. He invests in businesses that are predictable, simple, and essential. So when we apply this to Nigeria, we are not looking for complex startups or a stock that's just a gamble. We are looking for the foundational industries that power the entire economy. We are talking about banks, consumer goods, and critical infrastructure. These are industries whose business models are straightforward and whose products are in constant demand, whether the economy is booming or struggling. This immediately disqualifies industries that are too speculative or unstable. Think of those companies that trade for a few naira and are here today and gone tomorrow. Buffett wouldn't touch them because the business model is fragile and the risks are too high to properly assess. So we still ask the question: which company passes this first critical test? Let's consider Okomu Oil. Their business model is as simple as it gets. They own vast plantations, they process palm oil and rubber, and they sell it to a market with insatiable demand. In Nigeria, palm oil is used almost in every household and consumer product. It's a non-negotiable staple. This is the kind of straightforward, essential business Buffett loves, one where you can predict its demand for the next 20 years just by walking into a supermarket. However, even a simple business model has its risk, and Buffett is a master at risk assessment. For Okomu Oil, the risks are clear. They are heavily dependent on commodity prices and crucially on the stability of their farmland. They face significant operational risk like security issues and disruptions that could affect their ability to produce. These are the kinds of risks that are tangible and manageable, unlike a brand new tech company that's hard to figure out how they actually make money. This is exactly the kind of deep thinking we'll apply to our next filter. Now, having a simple business model is only the first hurdle. Buffett will tell you that the real test comes from the earning power. Because here's the thing, a company can sell something essential, but if its profits rise and fall like a roller coaster, that's a clear red flag. Buffett hates unpredictability. He calls it lumpy earnings, and he avoids it because volatility makes it harder to project the future. So let's apply this to our country, Nigeria. If you scan through the market, you notice some firms are slaves to external forces. Take oil exploration companies. When global oil prices crash, their profits evaporate. Or look at businesses exposed heavily to FX swings. One currency devaluation and their entire balance sheet gets scattered. These are not the kinds of earning streams Buffett likes to bet on. But there are exceptions, guys. One that stands out is name insurance. Insurance at its core is a float business. You collect premiums upfront, you invest them, and you pay claims later. This creates a steady pipeline of cash. And in Nigeria, where insurance penetration is still very low, the runway for growth is enormous. What makes NEM compelling through Buffett's lens is its consistency. Year after year, it has managed to grow gross premiums and deliver profitability without the violent swings you'd see in more volatile sectors. Of course, Buffett would also weigh the risk. For NEM, the risk isn't about demand. People will always need insurance, but rather it's about trust and regulations. In markets like Nigeria, low adoption and governance issues can slow down growth. Yet, for a patient investor, those challenges can also mean opportunity if management keeps execution tight. So while Okomo Oil passes the business model test, NEM Insurance clears the hurdle of consistent earning powers. And that's how we build Buffett's Nigerian shortlist, one filter at a time. So far, we have found businesses that are easy to understand and can generate consistent earnings. For Warren Buffett, that's still not enough. He has a saying, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it's the reputation of the business that remains intact. In simple terms, what Buffett is trying to tell us here is that he backs trustworthy long-term focused leaders. For Buffett, a great company is only as good as the people that are running it. He wants managers who treat shareholders' money as their own, who are transparent, frugal, and act with integrity. This is a critical filter for investing in Nigeria, where poor governance and a lack of transparency have often been the downfall of otherwise promising companies. Insider games, lack of clear succession plans, and shady deals are all red flags that Buffett will spot from a mile away. So who in Nigeria passes this test? Let's talk about Aradel Holdings. Aradel, formerly known as Niger Delta Exploration and Production, was founded by a team of visionary professionals led by the late Chief Godwin Arrett Adams. Their original goal was to build a company that ordinary Nigerians could own and participate in. This wasn't just about making money, it was about building a legacy and a truly indigenous oil business. For over 3 decades, the company has shown a rare combination of stability and foresight. They pioneered the marginal field development concept in Nigeria and have a history of sound decision making, from eliminating gas flaring years before the government mandated it to their strategic expansion into refining. They have also had a history of consistent, stable leadership that has seen them through multiple market cycles. But let's be honest, even here, a potential investor like Warren Buffett would be very, very cautious. The oil and gas sector in Nigeria operates in a complex political and social landscape and social environment where the risk of government interference and community unrest is real. Any company in this space must have a management with a track record of skillfully navigating these challenges, something Aradel has demonstrated over the years. This is the kind of qualitative judgment that goes beyond just looking at the numbers and gets to the heart of what Warren Buffett values the most, which is people you can trust. We have now established what makes a great business, but a great business isn't great investments unless it rewards its owners. This brings us to a key pillar of Buffett's strategy: dividends and shareholder returns. Warren Buffett loves businesses that generate so much cash that even after investing in their growth, they still have plenty of leftovers to pay their shareholders. Dividends for him are proof that the earnings are real, not just numbers on paper. They are also his way of reminding investors that patience actually pays. So how does this apply to Nigeria? Let's take a look at 2 very different cases. One is NGX Group and we have Okomo Oil, which we have talked about previously in another filter. Now you might be asking, why would Micah add NGX Group? He only went public in 2021 and have barely 2 years of dividend history. You see, that's actually a fair point. But remember, before its demutualization, the exchange wasn't designed to pay dividends at all. It was a not-for-profit. Today, it's a listed for-profit company with a business model built on transactions, listings, and market data. And every time a stock is traded, every time a company raises capital, NGX earns a cut. That's a monopoly-like moat. The short history of dividends isn't the full story, guys. The future is what matters here. If Nigeria's capital market deepens, if more companies list, if trading volume rises, NGX's cash flow and dividend potential grow massively over time. That's exactly the kind of compounding runway Warren Buffett loves to imagine. But let's contrast that with Okomu Oil. Unlike NGX, Okomu doesn't need to prove its ability to pay shareholders. It's been doing so consistently for over a decade. Its dividend history is very long, generous, and growing. Yields have often been north of over 6 to 7%, and payout has grown almost 70% in just 5 years. This is a classic Warren Buffett territory, a business with simple economics, steady demand, and management that actually returns money to its owners. And because Okomu's operation throws off so much cash, it can pay dividends while still reinvesting in new plantations and processing facilities. Of course, neither company is risk-free. For NGX, the risk is that its fortunes rise and fall with the Nigerian market itself. If volume dries up, so do their profits. And for Okomu, risk comes from commodity price swings and operational challenges like security and farmland stability. But taken together, these two stories capture the Buffett lens perfectly. One company showing a proven record of rewarding shareholders, another showing the promise of future compounding if Nigeria's market matures. Now that we have put these filters to work, the picture becomes clearer. Out of the entire Nigerian exchange, only a handful of companies really line up with Warren Buffett's timeless philosophy. The first is Okomu Oil. This is a classic, Warren Buffett's pick, a simple but essential business that is producing palm oil and rubber for a market that never runs out of demand. Adding its strong dividends record and steady reinvestment, and Okomu looks like the Nigerian version of a consumer staple giant. Next, we talked about NEM Insurance. Insurance has always been a Warren Buffett's favorite kind of business because of the float. NEM brings that same consistency to Nigeria with steady premium growth and predictable earnings. For Warren Buffett, this would be the kind of compounder to hold for decades. Then we have Aradel Holdings. It's not the easiest sector. Oil and gas can be quite messy, risky, and political, but Aradel's history of innovation, strong governance, and vertical integration makes it stand out as one of the very few indigenous players that could actually survive and thrive across market cycles. This is the kind of management-driven company Warren Buffett actually respects. And finally, NGX Group. Yes, it's new to the market and the dividend history is short, but the moat here is undeniable. Every listing, every trade, every IPO, they all flow through the NGX. If Nigeria's market continues to grow, NGX would most likely become the toll gate to the entire economy. And that's exactly the kind of monopoly, kind of business Warren Buffett loves to invest in and actually hold for a very long time. If you had to stop there, guys, these 4 companies would likely make Warren Buffett's Nigerians short list. Companies with consistent earnings, if I may say, trusted leadership, and the ability to reward their shareholders over the long run. Now, that doesn't mean they are without risk. Like we talked about during the course of the video, commodity prices, regulation, governance, and political instability are always part of the Nigerian story. But if Warren Buffett was here today, his eyes wouldn't be on speculation or quick flip or capital appreciation too much. He would be asking a simple question: can I own this company for the next 20 years and sleep well at night? At the end of the day, guys, you need to understand that the real lesson isn't just which Nigerian stock Warren Buffett might pick. The bigger takeaway here is how he thinks. So let me throw it back to you guys. Do you agree with my short list? Would Okomu Oil, NEM Insurance, Aradel Holdings, and NGX Group make Warren Buffett's cuts, or do you have other names in mind? Drop your thoughts in the comment section. I would love to hear your feedback. If you found this video helpful or insightful, make sure to smash the like button so more people can learn and see a different way to invest in. And if you haven't already joined my WhatsApp channel, it's a channel, not a group. There's going to be links in the description and pinned comments. You get updates on what I'm researching and looking in the market. Thank you so much for watching, and as always, stay safe, invest wisely, and ndewo.